Hey, this is Jeffrey with another edition of Stock Smart, April 19th, 2022 edition, here with options expert Joe Waterman. And Joe, I think people are getting some of this wrong with what's going on now. My take on, here's what I'm watching. This is what I've been talking about for years, and it's a trade that if you made it and you were with me, it's time to probably get out of it. But one of the things I told people when I've been talking about it for really since last year, if you go look up old shows, I said, get in this now and sit in and ride it. But the ride should be maybe over. And that was really the TBF, which was essentially shorting the new bonds. But the move is made. That thing's up again, another percent. The thing's up to 20. It has a breakout look. I wouldn't short this, but I think we're in that position where, when you talk about like interest rates and what's happened, we know this, and this is what people need to know. The bond market will tell you what you need to know. Because it's 80 times, whatever it is, the number of how bonds are so much larger than equities, it's not even close. But right now, the 10-year sits at 2.913. It's up another 5 basis points today. Do you know what the long year, like 5-year out bond number is, Joe?
I do not.
Okay.
I probably should.
It's okay. I mean, most people don't, unless you go back way to like the 90s, early 90s, where you got it at 5 and 6, the 10-year. The 10-year.
You're talking about the 30-year bond right now?
Yeah, I'm talking about the 10-year bond.
Okay.
So 10-year Treasury generally sat at 3%. So, you're seeing that peaking out right now. You have a bunch of the Feds are behind because they should be closer to where the bond is. They're behind, which is why we're going to get 2 50-point hikes. But I think to me, I don't see this going much higher. I don't know where you're at, but you got 10-year run into early 2010, 2011, where this thing sits in between 2.75 and 3. What are you thinking on that?
Yeah, I'm not as far on your side. I mean, I think we're at an inflection point, and things could get better from here. But I'm a little bit of a doomsdayer too, so I know it's been a lot worse in our history, right? So I just don't know if we're, got this thing under control right now, or if like other countries are worse off than we are, so we might get the benefit of that, or if we're ready for a round two. But I think it does. If you're right, then I think technology could be really cheap right now.
It always is, but let's bring up a question. I have a question from Adam.
The average investor.
And Adam wants to know, would you still be shorting the market right now? And I'm going to throw that over to you, Joe, and see what you think about that. And frankly, we're going in earnings season. We're going to talk a little bit about earnings today because there's a lot of really interesting earnings coming up. But would you be shorting the market now?
I do like to. I want to be short the market just because the SPX is at like 4,600, I think, right here.
Mm-hmm.
So I think we're at like high levels, but that's just my inkling. But I don't really have a position on. I'm basically flat and nervous, as Dennis Gartman would say.
You're flat and nervous? Well, actually, that's what, if you look at volumes, that's where volumes are. Volumes are telling you that, the fear greed index is really low. People are not dipping toes. I mean, there's a lot of money that's rolled out of like exchange traded funds. There's been more redemptions than creations right now. You're in that period of time where people are putting money and hoarding cash on the sidelines. And you're seeing at the same time, it always feels really, really bad, right? And that's why I want investors to remember. And of course, it's your risk tolerance is a big part of it. But it's always when it feels really bad. And it feels really bad in a bunch of ways, right? Because you're getting all these commodities are so expensive now. If you go buy eggs at the store, if you go buy oil, gas for your car, if you travel and fly on airlines, the prices have to hit you there too. So everywhere we're paying more. So you feel like you're not able to make money in the market, and your inflation is probably outpacing what you've got in salary. Most people, if inflation's 7 or 8, which to me, I do believe we're kind of at peak inflation. I look at things like, I told people last year, I knew that the Fed was behind on the consumer pricing, the CPI, and because I was reading it. One of the things that threw me on the CPI was that I thought it was so incorrect was that they were doing phone interviews where they usually go out to stores and they actually get the pricing from the store. And over the phone, you know how people are going to be lazy. The information's not as good. And I did a show on this, and I thought it was really, and you really would have had to bring out, you would have to read the document, not just get it from like CNBC, because they didn't talk about it, but they talked that there was since COVID, there was a difference in the way they calculated it. And then you add all this stimulus, tons of free money, and you're thinking, you know, what's happened here? But it happened. And we got all this inflation, and it really, with the way that they unraveled that basket in the CPI, it seemed like it came out of nowhere. But people who buy things knew, you know, and
yeah. And I think you know, I think the middle class and the lower class are feeling the effects of this huge, which, you know, could stop the buying.
Right. My thinking is, just to get back to that question, and we can wrap on that, is I wouldn't be short the market right now. I'd be careful. And I think, you know, if you have cash on the sidelines, I think I'd dip some toes, but I would dip lightly and look for more positions or more places to get in. But I would not be short right now. I mean, to me, it feels like, you know, and I'll watch, and this is a good, you know, what ETFs really do well is gauge things like pricing and what's really happening in a sector. And like one of the things I told people to get in, and I hope you got in last year, and I know you laughed about it, Joe, when I said, hey, you know, commodities are up 75%.
Right.
But the DBC, the commodities index, which has been massively, it went from like, I don't know, it was like 17 a year ago. It's up to like 27. It's had a massive move, you know, and if you've been in it, you've done well with it. To me, it looks like it's kind of, we're going to get to a point of this where we're going to get, there's almost like a double top in it. And I'm thinking we're going to get this, it's going to start falling off. So what's interesting too is somebody brought up, do you ever play in transports? Have you ever traded transports at all?
You know, not too much. I know there is like what's the ETF for the transport.
Mm-hmm.
It's like a good way to do it.
It's like the XRT, I think it is.
Yeah, dry ships maybe might be another one.
Yeah, that's sure. A retail one, but there's transportation ETFs for sure. But what I'm thinking about those is what I'm hearing in a lot of the spaces where they're, you know, in transportation. I don't know if I'd be in that. I know last year, you know, if you were in ship containers prices had doubled, and a lot of those companies were doing crazy well. I don't know if you looked at that, shipping container companies.
I think container shipping gone from like 4,000 to like 20,000.
Yeah, it's like 3 or 4 times. It's absolutely, you know, kind of, it's gone crazy.
And like logistics guys are worth, like, they're valuable to every company out there probably.
Yeah, let's look up this one. Let's look up the IYT. That's a transportation one, and see where that is. There was also, you know, companies like different ones that I've been in. So this one's up 2.29% today. But this is reset, and now it's kind of bumping up again. This was at its high really in March. In March at 276, and this thing dropped heavily. But what I'm hearing about transportation is the problem with transportation is energy costs are so high that it's eroding the profit margin.
I can believe that.
And so even if they're, and now you're going to get, don't forget too, right? So let's say we do get inflation, right? So what does it really do? It's like Keynesian, right? So it's ultimately people can't buy as much, right? Isn't that what happened? I mean, that's kind of what we needed to do. That's why we need things to get more. That's why when it gets expensive, we need to tighten the money, right? To keep inflation down. So if things are inflated, it should then say that, hey, you shouldn't be able to buy as much. Right? That's what should happen, like that supply and demand kind of Keynesian thing. And so I don't know if I'd be in transportation right now. That would not be one that I would be running into. So I'm trying to think where, and I don't feel like safe in any of the havens that were safe. Like, do you think that, like, let's look at oil. Oil has had a huge move. So like USO is one. That's the United States Oil Fund ETF. That's had a huge move. That's down 4% today. So that thing hit the high. It had the ugly double top already. So, and now it's on its way down. So I'm kind of thinking, you know, this was the year, if you were short, like you could have shorted technology, that short arc, the SARC, which has done really well, or you could have been in the positives, which were commodities or energy, and you would be doing really well. Short of that, everything else has been terrible. So, but but trees don't grow to the sky, right?
Mm-hmm.
And so when I look at this, I'm trying to think, because I have idle conversations just with friends, and they're like, "Well, what are you investing in?" And I'm thinking, like, I all that other stuff is run too much is my feeling, and I think it's time for some of the stalwarts. Even you could be in value stocks, like you could just go and get into a dividend ETF might be okay. Something where you feel safe like that. But I don't think
call it the dogs of the Dow, but I don't know if it's called the mud anymore.
Oh, Dogs of the Dow. Dogs of the Dow was pretty good last year. I looked at it. I know I did articles on Dogs of the Dow, and some of those companies have done really well in the past. But there seems like there's more efficient. There are more efficient indexes or ways to really gauge it. But I don't think I'd be short in the market. That's kind of all what we're talking about. Hey, did you see Elon Musk seems to make the most news of anybody
right.
That's in the financial markets, for sure.
I've become a fan of Elon. I've been a hater of Elon Musk, and I don't know if you're going to ask me this, but I saw his TED Talk recently about Twitter. Did you see that?
Well, we could talk about Twitter a little bit, sure. I mean, I know he wants to change and revolutionize a platform, and they feel like he makes good points. I mean, it's almost like he took it was from like the movie Wall Street where Michael Douglas goes into that paper company. He goes, none of these people on the board own the stock. I mean,
right.
What does that tell you? And that's what he said, when Dorsey steps down, he's like, hey, why don't any of you own, significant portions of the stock? And I can tell you as an investor in something, if you're not, if you don't own a part of it, why are you there?
How committed are you, right? Well, and here's the other thing, just the layman's perspective of it. Like, even though I hated Elon Musk, there's no doubt that he was like revolutionary and a visionary, right?
Mm-hmm.
So what board in the country would not want Elon Musk to be a part of it? It'd be like having Warren Buffett on your board.
Well, I don't think he's going to get on the board. I don't think he's getting on there.
I don't disagree, but I'm just saying, like, isn't that like that would raise like a question to me if Elon Musk wanted to be a part of your company?
Right.
Why wouldn't you accept that or like encourage that?
Well, because those people have cushy positions where they make, probably a few $100,000 a year sitting on an inefficient board. When you look at, so Twitter's best rival would be to maybe look at it against like Snap or something. And Snap has outperformed. I mean, you look at the market caps of those companies, it's not even, it's not even close. The performance of the Twitter stock is just crap compared to like Snap, which you think, I'm still thinking like, who's using that? Are people sending like pictures of their private parts around other people still on Snap? I don't know why. I don't really know who uses that, to be honest, but I know it's a younger audience, but they've certainly done a way better job of monetizing what's going on at Snap. Let's look that up really quickly. So here's Snap, not great like year to date. 3 months. This thing's at 33 right now. But Twitter hasn't done anything. And if you look at the move it made, Twitter's big move really was just when Musk announced that he had that 9% share, which was kind of manipulative. I know we talked about that before, but it was kind of manipulative that he did that. But, at the same time, that's really what's accounted for the big move in the stock.
Mm-hmm.
And Snap is up. So if you look at 3 months, Twitter's up 27% just because of really Musk. And really most of that move happened when he announced that holding, which was the beginning of April. So otherwise than that, the stock really has been terrible when you look at it.
And it's off of a high around like 70 or 73 or something like that.
Yeah, and really the main criticism is that they have not monetized in any efficient or smart way. In terms of, how do you have a paid version? Do you have a free version? Do you have a ultra version or all these different things? And they haven't really done it. And it seems like their technology it's like way behind for some reason. If you wanted to create, you wouldn't get the people there, but if you wanted to create something like Twitter, you could probably create that in about 10 minutes. It's not a very complicated piece of software. What is it? It's an app where you essentially just put out like whatever it is, how many letters
press
you can put out.
Pretty much, right?
It's really it is just press releases. It's a really simple kind of thing. People know it. It's obviously got massive wide acceptance, which is the hardest thing to do when you're building a new business. But there's nothing special about the software. So the idea that you can't create new ways to monetize it is kind of befuddling to me. Even if they created some things that were kind of like, how do you build your own Twitter? How do you build up your Twitter? How do you do that? How do you have more followers? Even that, Facebook does a lot of those ads where they're monetizing way better on Facebook. So I think it's kind of interesting, but they did have an ex-CEO from like Zillow who came on, and he thought there were like two likely options. Number one, and I think the stock, what it's telling you is the stock going down today 2% on a good day tells you that option one is very likely. That Musk gives this up and just sells off his stock and makes a really huge profit. He makes something like 30% on his investment, which is a ton of money, by the way. And then to me, also, it seems, I don't know if he didn't really disclose his intent. I think it was kind of done in a kind of interesting way. But anyway, when he essentially, that he sells off his stock and he makes that 30% profit. That's one option. The other option he said was that essentially they would get some other company in that would keep it private or keep it public, but they would come in and maybe do some bridge financing or work with the company to restructure the board, which might be another option. But I think when you have like Musk coming in, that the takeover is going to be hostile. And I think that's why the Twitter board's kind of freaked out about his presence in the company. Because he already said to them, I think that in the short course that they should stop receiving salaries.
Yeah, and one guy's never used Twitter before.
Right, he doesn't even use it. So how would you know where it should go, right, if you're not using it?
Right.
Anyway, we'll see if they ban it.
The one thing I will say about is that I would just push back after watching that thing. I think he's going to go through with it, and I think he doesn't care. It's not, and I think I would bookend that with maybe Ukraine. I think he saw what the private sector can do, with Ukraine giving away the technology to kind of help the Ukrainians attack some of the Russian military assets, like with the satellite imaging.
Right.
And so I think he's doing this for the right reasons. As crazy as that sounds, I think he's concerned about free speech, and not in a Democrat or Republican way, but just as like it's the right thing to do. And if he's not going to do it, then who will do it? So we'll see. But as far as a trade, I don't know if it's a trade and even the poison pill is something that might be interesting, to share with the investors, because that's something that I get, but I don't understand why a company would do that, especially if you have, like a legendary person trying to acquire it. Like so the board wants to dilute their shares so that Elon Musk can't take control of it. It's kind of interesting. As a stakeholder, what does that tell you? Like they know more than Elon, I guess? I don't know.
Well, let's stay with Elon because we're talking about Elon. And let's talk to him about it. So Elon Musk, Tesla has earnings tomorrow. So I was looking at Tesla. I have some Tesla, and I'm a little concerned it's made a big move, right? What are you thinking? What do you see in the numbers on Tesla?
So with the Tesla Straddle, I thought it was going to be lower. Do you want to take a guess at what the Straddle is? Or just we can tell the investor. A Straddle is used for implied movement. And so it's really good to look at a straddle right before an event. Like in poker, it'd be like, when a card is about to be turned over, the value of the hands will change. So Tesla, let's say I think it's trading around 1030 right now. The straddle
it's 1024 right now. And So let me just tell you, so go on. The straddle's what?
$60. So that you can put a range on the stock, right?
Mm-hmm.
You just add like 1024 to 60, you get what, 1084? And you subtract 1024, 60 from 1024, and you would get 56, is that right?
Right.
So 956. So basically, with this market news, right, Tesla should be in a range between about 1084 and let's just say 1080 and 1060.
Okay.
The expected range for the stock. So if you were really bullish on the stock, right, and you thought it could go to like 1100 or 1150, then maybe you could look to buy a call spread or something. You know, you could look at like the 1060, 1070 call spread and see how much that would cost you, or the 1070, 1080 call spread, and see if that would be an interesting trade or not.
So what I did with the move, because I am concerned a little bit about supply chain issues. They already kind of they kind of had a pre-earnings. They talked about, you know, that they had made more cars than ever, but that they had some complexity and difficulties with getting into with some of their supply chain issues. They also had the 3-week. They also had the 3-week layoff in Shanghai. And now essentially, because of the regulation there, they're going to have their employees sleep in the factory, and they're going to work and they're going to sleep in the factory in Shanghai until May. So, you know, that brings up some interesting things too. So I was a little bit, I'm bullish on this stock, but in the earnings, this one might be a tricky earnings. And so I did kind of execute a 990 put. I didn't really, in case there was a surprise, I didn't want to write the call, you know, to have like the no cost collar we had talked about before on the previous show. Yep. But, you know, I bought it for 14, and I think right now it's up a little bit because I bought it when it was like at 10:30 today. It's at 10:24. It's wavered back and forth. It's been up 100, 100, 400, 500. But I think it's a risky this earnings. I think this earnings is going to be really interesting for Tesla, and I think it's moved so much. It was at 700. And it rebounded nicely, kind of like after the last earnings, they kind of sold off in earnings because it was up to like 1,300 at some point this year. So going into it, my thought would be just protect it to the downside, and that's what I was thinking. What do you think about that option here?
Yeah, so you said you bought the 990 put or the 900 put?
990 put.
And then for $14, I think you said? Is that right?
That's right.
And that's for Friday?
That's Friday expiration.
Yeah.
Going into earnings on Wednesday.
So the last 20 days, I just looked back the last 20 days of the stock, and it looks like it kind of based out around 900, 915. And then the high is 1152. There is a low print of 750 in there. You know what I mean?
Right.
But, so yeah, it looks like if it would break like maybe like 1,000, it looks like it could go, you know, maybe like 975 or something. It looks like it could fall a little ways.
Right, 975 like is one, 937 isn't. I think in the 920, 930 range, it has a lot of support.
Yeah, so, you know, I think like, you know, that seems like reasonable insurance, you know. And I don't know if you'd want to hold that all week, or if, you know, if you did start to sell off, you know, then maybe it might be a good chance to sell that put.
Well, I would think if it's in the money, I'd wait till Friday morning and expect to rebound based on what happened with Monday. I would sell it Friday morning though. Probably not wait Friday all day, because Tesla's one, even though we're still looking for huge growth here, right? Because the production they have is unmatched by anyone else. And we talked about this one other time. Let's just get into it. Let's throw the drop in there.
Stock watch.
Let's talk a little bit more about Tesla. I did see a really great interview. I was talking with one of the former production managers, somebody who was like had a C-level job at Tesla. And he was talking about how Tesla's production is so different than other EV companies because they're a software company first. So when Tesla uses chips, or when they have a chip shortage, they can change their software to work with other chips, where a company maybe like GM or Ford or all these new startups that are making EV cars need a certain kind of chip for it to work. So that's kind of the genius behind Tesla.
It's fascinating, right?
Yeah, well, I mean that means that they're way more versatile, right? So they're gonna not be as screwed up by a supply chain issue in chip manufacturing as other companies. Now there's some things that are shorted. There's shortage of neon because apparently Ukraine's a big source of neon, and that's a problem for chips that Tesla needs. But everyone's having that problem. But I think that they have more versatility in what they can do with the parts that they get, which is kind of interesting. So we'll see what happens with Tesla earnings. That comes up on Wednesday. Really good, interesting a week of earnings. We have a lot of big names coming up this week. And some next week too. Like I was looking at, we have Snap on April 21st. We have Tesla on Wednesday. Today we have Netflix. What are you thinking on Netflix? That one, I would not be in Netflix. I think I think it was always poorly understood as like it was a technology company. That's what they would think, right? I don't get also why why Netflix isn't better at like cracking down on user subscriptions, like where you have like 55 people in a household on one subscription. Yeah. You would think that they would be better at doing that, but they report after the market closes today. And that's going to be kind of interesting to see what happens with that stock, but it's gotten shelled. It's down like 40% this year. I'm not.
What do you think trades at a higher volatility, Tesla or Netflix?
Do you know the answer? I would think it's. I think it's
interesting because you can look at the straddles, right? So we talked about the Tesla straddle being, I want to say like $62,
right?
And it was a $1,000 stock, let's say, right?
Right.
Well, Netflix is a $350 stock, and it's got like a I'm just going to say a $35 straddle,
right?
Or it may be $38 straddle. So it's, about 2.5 times smaller. So you could 2.5 times that. So like, I think Netflix is trading at a much higher volatility than Tesla.
Well, and it should, because it hasn't performed at all. You always see. So even if I know, like, the reason that I would only have a short put on Tesla is because we know when it has a bad thing, it rebounds dramatically fast. It's not like other stocks. If you look at the history of Tesla, when it drops on something, it rebounds like within 2 or 3 days.
You're right.
So even if Tesla has some kind of bad reaction and they sell the earnings, the thing usually comes back in a day or two. So like I might even sell that put. Like let's say I get in the money on that put on Thursday, the day after earnings, I might sell it on Thursday if there's like really aggressive selling. Because if you look at the history of the stock, you could see Netflix, that has not performed anywhere near as well. Especially it hasn't had any return this year at all. And I think all the news Netflix prints is bad. It's down to a multiple that's actually reasonable, not for a media company. For a technology company, a media company should trade with a price to earnings somewhere around 18 to 20, closer to what the S&P 500 does. But a technology company which trades, higher than 30, and that's what Tesla's. Netflix is still trading at a price to earnings of like 30. So yeah, I think this thing, was at. Let's not forget where this was. November 21, it was $700. If you would have shorted, Netflix last year and had a long short on, you would have been, very wealthy with that short. And I don't know how much further it goes, but it's not going to recoup. If anything, they had a really great first mover advantage. What I think is, where Netflix missed to me is, why didn't they just have TV? Why didn't they have TV? I never got it. Like, why didn't you just add TV packages? Maybe they couldn't, but why didn't they add TV? Because that's the competition. Because if you look at all the other competition that's coming on, they have TV and they have movies. So you have something like Fubo TV, which I subscribe to, and you have Hulu and all these other companies that have their own independent apps. Why didn't they have TV? I don't get it. It just never made any sense. I've been talking about this for years. Why didn't they have TV? Because then they would have made themselves like indispensable. Right? Anyway, they wanted to be a movie company or a media company like that, and they make movies, and it's good, but it's going to be, the multiple is going to get changed, right?
Yeah, and it just feels like COVID basically brought a lot of their revenue forward, and it brought their competition forward, and now they got to deal with their competition.
Yeah, and they're losing subscribers. It's not going the other way. They're losing subscribers, and I think it's just because there's so much competition. And, now what I'm noticing too, and I got into a bunch of mini-series lately, what you're seeing now with a lot of the mini-series is they're releasing them week to week instead of like dumping them all. They used to dump them all at one time, and now they're releasing them week to week. That way the subscriber stays on longer. So you'll see you'll probably get, actually Netflix probably had, here's one reason, and this is the one way that they used to gauge this. Do you know, so I remember about 3 years ago, this was really interesting, and I don't know if you thought about this before, but the way that the stock analysts would gauge Netflix is that they would see what was most searched on Google. And if Netflix had the most titles, and one that they probably had that did really well for them was Ozark, because Ozark was really popular. They just had like a season finale, and then they did a really smart thing to keep subscribers, is that they released the whole bunch at once, but then they're previewing another release, like the final of the episode. But that's not coming now for another couple of weeks, I think. So that's really creative to me. That's a way that they're keeping the client, right?
Makes them sticky.
Yeah, makes them sticky because they want more. And I've enjoyed. I actually watched more Netflix recently than I had in years past because there were some series on that I liked. There was this Inventing Anna, which was actually the girl from Ozark who plays this is kind of a psychopath or sociopathic person who gets in with all these elite New York people and like just kind of steals money, and it's really kind of an interesting character. But anyway, they're having problems just because there's so much competition out there. And at some point, we're in a deluge. It's sort of like, we talk about sports betting, and I'm involved in that industry, but there's a deluge of these companies involved in sports betting too, and there's going to be a washout, and then only the strong will survive. We know that's going to happens. And the same thing is going to happen with streaming. You're going to have the main players, but I still don't know why Netflix didn't bring TV on. I never got it. I don't know why that would have been. Doesn't it make sense that they should have just had TV and been a one source for everything?
Yeah.
I mean, what's the difference?
No, and like you said, because like even Amazon Prime, and so like my kids are going to that a lot,
or YouTube TV. I actually did I wanted to watch the Bulls game the other night, and it was on TBS, and that's one thing that Fubo doesn't have. And so I actually signed up for YouTube TV for one day because I wanted to watch the Bulls lose to the Milwaukee Bucks. And so after that, I canceled the subscription, which is what people do all the time now. They're really good at it. So that's what people do in most of those scenarios. And then they offer you the world to try to stay. But if you can make it through the cancel, uncancel buttons, because they usually put them all, it's so complicated when you try to cancel stuff because they put all the buttons, or we have this offer. And then you got to find the cancel, which is in really tiny print to keep going. And then you cancel and you go through another screen and they're like, are you sure? And then they're like, well, we could give you everything. And then they're like, and you still have to cancel. That's the pain in the ass.
What's the joke? Like where you basically buy the company at the end of it when you buy like a MyPillow thing. It's like, you're the new owner of the company. Press 8.
Right.
I found the unsubscribe button. Like I hated my email for years. And I finally found the unsubscribe button in like very small print at the bottom of the promotional email. And now I can like use my email again. But I'm a Luddite. I'm a Luddite.
I'm so glad you found that, Joe. I didn't want to have you, wasting a bunch of energy on that.
That would keep me away from like doing all this stuff is because it's like, as soon as you sign up for it, you're just going to get, because no matter what I do, like you put it in your junk, it still comes back somehow. And then finally I got the unsubscribe and now it's not coming back.
It's like a boomerang.
I digress.
I just found something yesterday that I was subscribed to that I didn't remember. And that's that's the scam, man. You need to remember what I'm subscribed to. That's a problem. But let's look at some of the other earnings. And then there's one I really want to talk about. So we have Tesla on Wednesday. That's huge. That's going to be really interesting to see. Boring old AT&T on Thursday, American Airlines, some of those companies. We had some of the banks coming out, airlines on Thursday. And then on Friday, we have Verizon, American Express. Not really interesting. I think next week we get the big tech ones that people really care about. On Monday, we get Activision Blizzard. Kind of interesting. That was the one that was acquired by Microsoft. Then we get Microsoft on Tuesday, which has been just kicking ass. It's been great. The one I want, and the one that I put on, and we can go again with the little drop in here.
Stock watch.
Is Google. Google to me, how can Google be? I don't know why Google trades at a price to earnings of it's so cheap to me when I look at Google. When I look at Google with an EPS of 113, trades at a price to earnings of 22.75. How can that be? How could Google trade that cheaply? And to me, it's got a lot of room to run. And I think this is one where if I'd be long into something, I'd be into Google because we saw last time we had earnings, and Facebook's coming up too. And I want to talk really quickly about maybe buying a put in Facebook and what you think about that. And maybe you can pull up the straddle in that. But if you look at Google, Google has taken over a lot of the advertising because Facebook is faltering a little bit in their advertising because of what's happened with the iPhone and a lot of different regulations on different ways that they can do the advertising. And they had that they're investing more in Meta, and their Oculus and everything. And Facebook's maybe dropping the ball a little bit, and I think Google's taking over, and they had just knock out of the park. They had knock out of the park earnings last time. So going into this, I'm going to be really interested to see what Google's doing. This stock had hit a high of in the 3,000 range. We already know there's going to be a 20-to-1 split. So that's also not a terrible reason to hold some Google. And the stock
there's
right
a lot of stocks that are splitting right now, right?
That's the big trend.
Google, yeah.
Well, that
so
trend.
I wonder if it's taking some of the wind out of the sail a little bit.
Well, we did have that stat on Tesla, and the Tesla stat was essentially that when Tesla announced their split last time, which was a large split, I think it was 7. I don't know. I can't remember the exact numbers on the split in Tesla. But when they did that split, Tesla had never, went up on the split news, which makes no sense. But they went up on the split news, but then never again reached that number that they hit on the split news. And so Google kind of did the same. Google jumped up really high, like a 140-point move on the split news, and then again has not regained that height. Now, I still think, though, this company trades cheaper than it should. And so it's to me, it's one that I'd watch in earnings. I for sure would watch it. This thing has been up to as high. Like, if you're going to feel safe, who are you going to feel safe with right now? If you don't like the market, I mean, you would have to think Microsoft, Apple, Google, Amazon. I mean, Amazon's been not a great, exciting stock, but this is not the year for Amazon stock, and that's going to be coming up their earnings too. So we'll see what happens there. But I don't know. Any thoughts on those, Joe?
Yeah, Google looks like it's definitely selling off in earnings. So if they do have a good number, it could definitely have a nice pop to it, I would think.
And that is a good setup.
The last earnings announcement it did too, right?
But that is a good setup. Selling off into earnings is the setup you want. Running hot into earnings is the one where that's the one you don't always want.
If you don't understand puts.
Right.
And then Facebook, you were talking about that. The Straddle on Facebook is $20, and it's like a $220 stock right now.
So what does that tell you?
It looks pretty flat on the 20-day, right? And so I'm kind of with you. I think Facebook, like the course Facebook is plotting is a very expensive course, and their deliverables are way out in the future. So I don't know. I mean, I kind of like disappointment in Facebook.
I know. I think the way that it's set up last time, I think Facebook probably has another bad earnings. If I were going to do anything in Facebook and I looked at it and then I'm like, I don't really need this other action on. And I was thinking, I don't know if I'd go and buy the put in Facebook, but I think that if you're going to do something in it, you'd be betting to go down more.
Yeah, and it had a low of like 185 maybe.
Mm-hmm. So it's got the potential to retrace that low, maybe down another. Where's it at now?
217.
217.
And if it breaks 208, then I think, it's going to fall.
So what would you buy? What would you buy? What put looks like it's like
enticing
well,
we just
you?
Said the 20, I would be looking at like 200, 210 put spread. What would that cost us? We could buy the 210 put for about 670, let's say.
So you would buy how much would you buy the 210?
That would cost us about 670. And then we could sell the 200 put for like 350. So for $3 for a $300, if you thought.
So you'd buy you would buy what would you buy?
It's a put spread. I'd buy the 210 put and sell the 200 put. And that would cost you about $3.
So, and you would sell the 200 put. What about, let's see, the 200 put will get you, so that'll cost about $320 right now.
Yep. And then if we were right and Facebook, sold off back down to lows, 185, let's say, that $300 bet, $320 bet would pay $1,000. And then you could adjust that. That's just the starting, the opening. If you wanted to go higher, it'd be more expensive, like the 215, 205. Or if you wanted it cheaper, you could pick lower strikes, like the 205, 95.
I like this. So
95.
So the 210 put, maybe like, I think the 210 with like, what number did we see the support was at? What was the old support after last earnings?
I'm just looking at it. When I looked at 208, it looked like it bounced off 208. I don't know if that was today or in the last couple of days. It looks like maybe today. It bounced off 208 and it's up $6 today. So the last couple of days, it kind of 208 and it's rebounded off.
And we saw the drop. The drop was down to 186.
Yep. And so when I look at that graph, it just looks like if it could get through, if it would, get through 202, definitely it looks like it could fall. But if it comes down below 210, it looks like it could drop and maybe touch new lows.
Yeah, it's certainly interesting.
200. So it's just a way that you can start to look at these securities, and one way is just to buy it outright, right? But that's a more expensive way. And then if you say, hey, if this breaks 210, I think it could go to 195, which would be $10 higher than the low, right?
Yeah, and I think the way that they guided in their last guiding, if you remember it, I don't know if you do, but I think the way that they guided it shows that they expect some trouble in the next few quarters at least. So
if inflation's still on, right, then that's not going to be good for tech companies. If inflation is over, then maybe it is good for tech companies. So you can have it either way, but that's what makes the options nice, is because you can make a small bet with a bigger reward.
Well, and I think what we're getting, the added noise with inflation comes from what's going on in Ukraine, to me. Because I think when we hit that 7, I think we finally, because the Fed would come out, and whatever they wanted to call it, transitory. Okay, well, we knew that wasn't right. And then they came out, the first numbers of the CPI were we're at 3 or 4, and then we were 5, and then we're at 7, and then we're in between 7 and 9. Okay, that's it. That's probably where we're at. And that's just from my cursory and from what I'm seeing. And I'm also seeing what's good news is that, and I want to talk about this about the bond market, and we kind of wrap on this, but the bond market's kind of done its work. I mean, if you look at a house right now, if you're going to buy a home mortgage, right? So if you were in the market last year at this time, and now you're in the market this year, 2% more on your loan.
Yeah.
The 30 year has gone from 3 to 5%. So you know what the last,
which is still historically not a bad rate.
It's not bad because our parents paid 10.
Yeah.
My mom's first mortgage was 10, and it wasn't because she had bad credit. It's just because that's what it was. But those were the days when you would go into a bank and you'd actually get a toaster. That's when that's when interest rates were you could actually put money in a savings and get a return. That doesn't exist anymore, really. I mean, most people who have money markets if you have a lot of money, maybe you get 1%.
What does Mark Twain say? History doesn't repeat, but it rhymes.
But it what?
But it rhymes.
Yeah, right, exactly. So, we're seeing that rise in interest rates, but with the 5%. And then what that tells me, too, with mortgages, and this is something to watch, is this is when you get that danger point, because you're going to get people who want to buy, who start buying things with money they don't have. And they start getting into these 3 and 5 year ARMs, these adjustables, and people might be getting hit with some of those 3 and 5 year ARMs as we speak. So if they're adjusting now, you think about this. I'm not saying that we're going to have a doomsday scenario with mortgage rates, but I think we are getting, because property values are still going up, but that's kind of, we're peaking. I watch a couple markets all the time. And I know that we're getting kind of peaked out in a couple of those markets. So I'm seeing that right now. So as we continue to see that, that we're going to have more absurdities in the marketplace, whether it's people, adjusting their arms and not being able to, or if we see defaults again. We're not in a big short scenario yet, but the interest rates are really high. So it'll be interesting to see how that impacts, the average everyday person who's going to have to either refinance or look down another path to keep their house. The good news is that there's still a lot of equity in these homes. So I don't know if you have any other thoughts on those, or that's it for today, Joe.
Yeah, no. The only thing I was watching something yesterday where a lot of the really expensive property is adjusted through ARMs, right?
Right.
Because I'm sure the people have a lot of money in the stock market and stuff. So I wonder when those ARMs come due if they're going to be looking I don't want to, could that bring selling in the marketplace? To pay off, because you're going to have a decision to refinance or to pay off, right? when you have an arm like that comes due. So
yeah,
so,
well,
I just
the only thing that's good about that though, the only thing that's good about that is that people have equity, and so that gets they can either sell or get out of their house or work something else out. But if you have equity, if you don't have equity, that's when you're in trouble. So when we start seeing decrease in price value, which is the next thing to happen, right? So if you look at things like, if you look at a good ETF to look at to see where the sky's falling out on this thing is the Nail. It's called Nail, and it's the home builders ETF, right? And that thing, the sky is falling there, right? That thing is up today. It's up big, but that thing it's gotten thirded. So in December of 2021, just last year, this thing traded at 120.48. Okay. And now it trades at, you want to guess?
No, I have no idea.
And this thing is up 10% today. It trades at 39.60. So this thing has dropped, three quarters of its value, or almost three quarters of its value. So you can see that this has already happened. It's like the moves happened already. And that's what I think with the market. Like, we saw it already. The moves happen. The move in the 10-year affects everybody more than what the Fed does, which is what I want people to realize. That overnight lending rate doesn't really affect you because the bond market's already adjusted to it. You know what I mean,
yeah,
Joe?
Yeah.
I mean, so
yeah, no, it's like,
and that's why
what you're getting.
Right. That's what affects people, the 10-year. And it's already happened because the bond market always is smarter. The bond traders are way ahead of the equity traders, always. And so my point is that let's see where this 10-year goes. Its 10 or 12-year number is 3%. Now, if we see some breakout past 3, which I don't think so is going to happen, but if we see some big breakout past 3, then I would say we still have more inflation to go. But this is where it should be because this is where it was for a decade plus. So that's my only point on this. So, in 1994, we had the 10-year at like 7. In 1999, we had it at 6. We had it at 3.8 in 2002. And then we've seen, though, from like 2011 on, we've seen it anywhere from like 3, right in the 3s, and that's where it sits. So I think it's normalized. It's where it should be, and I think that we need to watch that. I would keep watching the 10-year to know where you should be trading. So that's kind of my advice.
In Japan, hasn't it been like negative for like 30 years or something like that, or zero for?
Yeah.
So like we live and that's the argument is like, do we live in this like new environment with zero interest rates, right?
Right. Well, and that Fed rate, as it goes up, the bond market's saying, hey, you guys should move that up a little faster, by the way. That's all it's saying. You need to catch up. It's not like the 10-year is going to go more bananas because the Fed catches up because it's already there. Mm-hmm. Anyway, that's my look at it. Let's see what happens with it. And maybe we'll have to talk to our friend Rick Santelli.
All right, and then we'll check out these earnings next week.
Yeah, sounds good. Hey, Joe, have a great week. Thanks for being on. Thanks for all the listeners, and we'll see you again next time on Stock Smart.